Hello and welcome to this webinar CFA Level 1. This time we are talking about, let's wait please. This time we are talking about equity, valuation of equity investments. Let me just start to record this screen please, and now we can really start, which is now. Yes, cool. Thank you for coming over virtually. As I said last Wednesday, I'm trying to establish these free webinars, CFA Level 1, each and every Wednesday. And last Wednesday, we did corporate finance and we did financial reporting and analysis, actually. And this time, I want to talk about corporate finance, first of all, and then at 6 p.m., I want to deal with derivatives. So this time, corporate finance. Let me just point out, I uploaded this part of my mind maps. So CFA Level 1 mind maps dealing with equity, with derivative, fixed income, of course, with alternative investments, quantitative methods, and so on and so on. So all the 10 topics, all the 10 major subjects that you need to keep in mind, and to help you better keep in mind those things you need for your CFA Level 1 exam, I created those mind maps. So here, this is just a tiny little part of those mind maps that I have for you, and we'll deal with those 3 pages. So equity investments in the 2020 curriculum is study session 12 and study session 13. And we'll deal with the very last reading, equity valuation concepts and basic tools. So now this is, let me just scroll down one page for you here. Equity valuation. So there's 3 major ways of valuation equity. And these are the present value models. So here, the categories of equity valuation models. And first of all, there's the present value model, or let's better say there are the present value models. So you have dividends. Dividends coming in each and every year. I mean, hopefully. There doesn't have to be a dividend paid out by the company, paid out by the firm, but hopefully there are. Dividends. Now, let's say if your investment horizon is 3 years, so you have a dividend coming in the first year, in the second year, and in the third year, you have your expectation of what the dividend might be, and then you have an expectation of the interest rate, of the opportunity cost of capital. So this interest rate, you will be discounting the dividends coming in, hopefully coming in the future, discounting by the interest rate, or discounting by 1 plus r to the power of 1, 1 plus r to the power of 2, to the power of 3, dependent on the number of years to come. This is it. And in the chat we have Jacobo. Nice to see you. Nice to meet you virtually. I mean, are you still in Switzerland? I think, if I remember correctly, you were based in Basel or something, in Switzerland somewhere, and you were Italian born, right? Okay, in Baden, I see, cool. Close to Zurich. All right. Now, as I said, I uploaded 2 things and I sent you by email 2 things. So first of all, some topics we're dealing with, some questions we'll be dealing with, and second, this mind map, or part of the mind map for CFA Level 1. Today, we are dealing with equity investment. So now, there's 3 major ways of valuation equity investments, and this is first of all present value models. We have the expected dividends in the future, and we discount them with our expected discount rate. Second, there are the multiplier models, share price multiples, enterprise value models, and that's a totally different story. Like with all those 3 models, we try to compute, we try to evaluate the intrinsic value, of a share, and but we do it in three totally different ways, like discounting with the first, and computing multiplier models or enterprise values. And with the third one, it's the asset-based valuation model. Asset-based valuation model. So if you take a look at the balance sheet, there's on the left-hand side of the balance sheet, there is the asset side. On the right-hand side, there is the equity. There's equity and there is fixed income. So there's debt, there's liability. And if you subtract from the asset side, if you subtract the liabilities, you get a feeling, you get an expectation of the equity. And thereby, this is how the asset-based valuation model works, right? So in order to compute the value, the given value of shares, that's the way we do it with the asset-based valuation models. But just keep in mind, taking a look at the balance sheet doesn't give us the market value. It gives us the it doesn't give us the market value instantaneously, because in the balance sheet there isn't written the market value. There's just the book value, right? So book value is given, and we need to do some adjustments, whether they are positive or negative, but there need to be adjustments to the book values in order to reach the market value. So this is the third one, and we're dealing with the first only. Today, we're dealing with the present value models in order to give us an understanding of how to compute the intrinsic value of a given share. So this is the second page, and the third one, present value models. First of all, dividend discount model. And first, are we using the future dividends, or are we using free cash flow to equity models? This is the thing we need to be looking at here, using future dividends or using free cash flow to equity. And there is a certain difference. We'll shed some light on this later on. So this was this. And if we look here, first, we need to go to the second page. Equity investments. So now, which could be your question, part of your question, or one of your questions in the next CFA Level 1 exam. If I recall it correctly, Jacobo, you're going to take the exam only in June next year, right? You're not going to participate in 2020, in December 2020, but you're taking the exam in 2021, if I recall it correctly. Now, Martha X, an investor living in New York City, expects a share to pay dividends of $2 in the first year, and then $3 in the second year, $5 in the third, and $2 at the end of the investment horizon, at her time horizon, $2 in the fourth and the last year. Now, those are the dividends expected by her. And she asks herself, now, what's the price of the share? Like, she doesn't have a price of the share in this first question. She does have a price in the second question, but that's a tiny little difference between the first and the second question. So now her question is the following. What is her expectation of the share price? What is her expectation of the share price? Thereby implicitly answering the question whether or not the share is undervalued or is overvalued or is fairly valued, but which is the question only here in the second one. So in the first question, we're dealing with the computation itself. The computation itself. Now, where is my pen? I need a digital pen. Here it is. Now, if we consider it this way. There's the investment horizon. There's the first year. So we're standing today at the end of year zero, right? So to speak. Year zero, we're standing at year zero, at the end of the year zero. There is the first year, which is 1 year from now. There's the second year, which is 2 years from now, etc., etc. And we're looking at 4 different years. In the first year, the share pays a dividend, or is expected to pay a dividend of $2, which rises to $3 in the second year, to $5 in the third, and which goes down, unfortunately, from her perspective, unfortunately, to $2 in the fourth year. And on top of this, there's the terminal stock value. There's the terminal stock value of, say, $10 if she sells this share in 4 years from now. In 4 years from now, there's the terminal stock value of $10. What is the value of today? Do you have any if you are to take a guess, Jacobo, what would you say? Your turn now. Because the thing is, you must remember it from quantitative methods already, the time value of money. It's reading, I don't know, reading 7, reading 8 something. Time value of money. Actually, I think it's reading 5 or 6. But anyway, we discount it, exactly, we discount it. We just discount the values given by this estimation. So, and the interest rate is equal to 12%. Which means that $2 divided by 1.12 plus $3 divided by 1.12 squared, and so on, gives us an estimation of the share's value. And in the fourth year, it's not only the dividend paid expectedly, but it's the share price valid 4 years from now at the end of the investment horizon, which should be, in her mind, $10. So 2 plus 10 divided by 1.12 to the power of 4, which is actually the net present value. There is a little distinction, by the way, Jacobo, between the word present value and net present value, because net present value, to my understanding, always includes the value of today, or the payment, the payment of today, but there is no payment of today. So maybe it's better to call it the present value than net present value. This is this, and it is 15.36. So $15.36 should be the correct valuation given a dividend discount model. So if we consider a dividend discount model, and there was no choice at all, because there was no possibility whatsoever to estimate assets or to estimate liabilities. I'll be back in a second. Give me 5 seconds, please. Sorry about that. There was somebody at the door. So now, what did I want to say? Yes, computing or taking into account the dividend discount model, we just discounted the future expected dividends, and the result is that we would expect a price of $15.36 to be true right now in this period of time. This is the first question, and the question was yes, and the answer is C, isn't it? The true answer should be C. So if this is your expected question in the next CFA Level 1 exam, this would be the answer. Same question, but with a different outcome. We're not taking a look at the value itself. I mean, the value itself, of course, stays the same because the dividends are the same and the interest rate is the same. And there is one further information, which is $14. So if the share is currently trading, at $14, her conclusion would be that the share is overvalued, undervalued, or fairly valued. Because, like we computed in the first question, we computed a value to be true of $15.36. Now, given the information that the value that the share price is 14 only, this would actually mean that the share is overvalued or undervalued. And Jacobo from Switzerland says it is expected to be undervalued. Let's think about this. So yes, she expected to be $15.36, but the actual price right now is 14, and so she expects it to be undervalued. So this answer would be the same. In the CFA level 1 exam, this does not happen to be like there were never two questions being together like this, being connected like this. But I mean, there are several things that we can look at a different at the same question. So why not do it this way? This was question 1, question 2. So an equity valuation model focusing on expected dividends is which one of these three? As I just said, there's three different possibilities, in which the first deals with the discounting of future dividends. So it's a bit easy to say present value models is the true answer. Dividend discount models especially is the true answer. And there are the multiplier models telling us they're chiefly based on share price multiples or enterprise value multiples, which isn't the true answer here. And there's the third one, the asset-based valuation model. An asset-based valuation model means that we're looking at the balance sheet, thinking of like market value of the assets, not the book value, but the market value, and looking at the liability side and the market value of liabilities, not the book value. So there is a difference, and we need to adjust for those differences. But of course, here the true answer is B, isn't it? Dividend discount model is the one and only true answer here. So now this was this, but of course there is more. This is not the end yet. If you're thinking, Jacobo, that we're finished for today, you're dead wrong. You would be dead wrong. Because here I tried something else. And the thing is, do you really have the necessary information? We're talking about cash flows, cash inflows or cash outflows. But when looking at a balance sheet, when looking at an income statement, this isn't about cash flows. You might have to look at the cash flow statement, but from the balance sheet or from the income statement, you don't get the cash flows. That's why we need to adjust something. And this adjustment is called the way of getting free cash flow to equity. Free cash flow to equity, which is operating cash flow minus fixed costs dealing with investment plus net borrowing. And net borrowing means the money lended, the money given to us by banks minus the money given back from us to our banks, right? So borrowing minus repayments of former credits is equal to net borrowing. So this is free cash flow to equity. So let's consider this. 3 years, 1, 2, and 3. There is net income. Net income, of course, is the result of the income statement. Then there is depreciation and amortization. Depreciation and amortization. There is fixed costs dealing with investment. There is borrowing. So funds granted to us by our banks. Borrowing. There is repayment of different funds, repayment, and there is interest paid. 20% of the money taken out is going to be paid as interest. Interest paid, 20%. Interest paid, 20%. Now, let's further discuss dividend discount models, and we need to consider the influence of this net income to cash flow, because net income isn't a cash flow at all, so we need to adjust something. Let it be 100, 250, whatever currency here. Depreciation and amortization. In order to reach this net income, we subtracted depreciation, we subtracted amortization, whether it's tangible, so depreciation applies, or intangible, so amortization does apply. 60, 50, and what's the last one? 10. So by the way, this would be operating cash flow, right? This would be called an operating cash flow, but this is not part of the answer. This is just a different answer to a question that wasn't asked. Now, fixed costs. Let there be fixed costs of 20, of 10, and of 10 again in the third and last year. Borrowing is equal to 30 to 40 to 50, which is actually a cash inflow, of course, like the bank grants us credit, like it's $30 cash inflow, or $30,000, or 30 million, whatever. Repayment, there's a repayment of 10, there's a repayment of 10 and 10. So every year we repay $10, and there's $2 of interest paid each and every year. Now the question is, what is free cash flow equity? What we need to ask, and what we need to know is not the free cash flow to the firm, but what the free cash flow to equity holders, right? Like there's two capital holders, two possible capital holders to the firm, which is banks and which is equity holders, shareholders. But we need to consider what is the part of the equity holders only. And they are to receive net income, of course. I mean, it's their share on this company, so it's theirs. Net income is theirs. There's depreciation and amortization. Since net income is never or hardly ever a cash flow, so we have to adjust for everything that was subtracted and that was added in a way that was correct in order to compute net income, but it was not correct in order to compute cash inflow and cash outflow. So since it wasn't a cash outflow, we need to readjust it, we need to re-add it. So 100 plus 60 would be a better way, would be a better approximation of the free cash flow to equity. As I said here, the formula is this. The true formula is this. So cash flow of operations need to first take net income, then add everything that was subtracted without a reason when it comes to considering cash flow. Right? There was a reason, of course, when computing income, but there was no reason whatsoever when computing cash flow. Now, 100 plus 60, so 160 would be the cash flow of operations. What is, Jacobo, to your mind, what is the free cash flow equity? What to say now? What is the free cash flow to equity? Now this gives me time to drink some tea. And by the way, did you watch the video already? 158 would be wrong. But did you watch the video already? I don't remember. What was the webinar that you attended last week? Was it I forgot the topics. Was it financial reporting and analysis, or was it corporate finance? And did you watch the video already? Two questions at the same time. And 158 is wrong. And I see what the mistake was, but I'll tell you later. I will tell you later. Financial. I see. But it's there, and I think I sent you the link, didn't I? You should have the link. And it's there. Yeah, the video is there, and you're more than invited to watch the video of last week. So now, free cash flow to equity is, of course, 100 plus 60 minus the fixed costs of investment, because they must be subtracted, because they are not included in net income, because they didn't lead to any expenses so far. They didn't lead to any depreciation or amortization, but they need to be subtracted because there is no cash staying there any longer in order to be distributed to shareholders. So actually, we have to compute 100 plus 60 minus 20. Now, net borrowing, we get $30, we have to pay back $10, but the interest written there is just in order to confuse you, right? And obviously, it did confuse you because they're part of net income already. So there's no use in pointing out that it was $2. So this was a cash outflow. This was a cash outflow and was part of the expense side. So there is nothing to adjust for these $2. So they're not part of the adjustment. So actually, it's 160. So it was wrong, Jacobo. It was wrong to subtract 2. The true answer is 160. And it's good to commit some faults here. It's the best way of learning. Are we not missing working capital requirement? What do you mean? Like fixed costs of investment is the working capital requirement. So no, the answer is no. We're not missing them here. So $160 in the first year. How many dollars in the second? Again, the same calculation applies. The same calculation applies. 200 plus 50 minus 10 is 240. 240 plus 4, 280. Minus 10 is 270. No adjustment for the 2 because they're part of net income already. So it's 270 free cash flow to equity in the second year. And in the third year, to my understanding, it is equal to 90. It's equal to 90. So these are, from starting at net income, we arrive at free cash flow equity. And this is just the right thing, because free cash flow equity is needed in order to be discounted, in order to reach the intrinsic value of the share, which should be now, as a consequence, which should be 160 divided by, did I tell you that the interest rate is equal to 8%? No, I didn't. Sorry about that. The interest rate should be 8%. And so 160 divided by 1.08 plus 270 divided by 1.08 squared plus 30 years from now, 90 divided by 1.08 to the power of 3 should give a result 450 1.07, if I computed correctly. If I didn't, just tell me. Just tell me if I didn't. Cool. That is this. And yes, this is what I wanted to tell you about free cash flow to equity. And I would say, I said that I would be talking about free cash flow to equity and the dividend discount model. So this is the true idea of dividend discount models. We just take the dividends and we sometimes need to compute those dividends, and sometimes they're not just given in the CFA level 1 exam. So using this, for example, the computation, the calculation of income statements. So we need to take those net income numbers and do some adjustments in order to reach the dividends we're looking at, and in order to compute them, to discount them. Are you going to take part at 6 o'clock, Jacobo, in the derivatives webinar? If yes, good. Feel free to do so. If not, you would be able to receive the webinar, the video, if you want to. Yes, cool. So that's it for now. I'd say we see each other at 6 o'clock. Do you have the link? You have the link for the webinar at 6 for derivatives. If not, just tell me. I could give you this link again, but I think I posted the link. Yes, I did post the link on Facebook, so you should have it. So cool. Yes, thanks everybody for watching this video, and I hope to see you again next Wednesday. We'll be talking about what are we talking about? Actually, I forgot. I think it should be ethics and quantitative methods. I think ethics and quantitative methods. I'm not quite sure about it, but next Wednesday it's going to be two further webinars dealing with CFA level 1. So in this Corona crisis, I would like to establish those free webinars, CFA level 1. Thank you very much for watching. Thank you very much for joining.